Good morning, everyone. This is John Malloy with Redwheel, manager of the Global Emerging Market Strategy. Thank you for joining us. I'm joined this morning with Cem Akyurek, who I've worked with over a decade, our Chief Economist. We've been in emerging markets for well over 2 decades. And I'm also here with Felipe Labbe, who joined us a few years ago, and he works closely with Cem on our macro analysis. As you know, we do all of our macro analysis in-house. Currency forecast, rates forecast. We look at what sell-side research is, recommending and their forecast, but we don't rely on it. We also don't rely on third parties. So all of our work is done in-house. We just ended the first half of 2023. It was, pretty uneventful for emerging markets, and frankly, emerging market equities underperformed global equities. And we'll talk about that in a moment. I think it is interesting to note, though, we started the year in January with a very strong emerging market performance, and actually June was strong again. And so when we look at the second half of the year, we're actually pretty encouraged in terms of the backdrop for EM. We do have a view that global growth will pick up, and as we see rates stabilize and currency stabilize in emerging markets, the backdrop is very, very constructive. Cem, let me hand it over to you to hear your thoughts on, maybe the first half of the year, what those headwinds were for emerging markets, and then the second half of the year, why we should be, more encouraged in terms of EM equity outlook.
Felipe and I had, for the longest time, thought that emerging market policymakers had done a great job through the difficult times of COVID and rising inflation and rising global rates. And emerging market economies have shown a lot of macro resilience. But I think investors were sort of hesitant to invest in emerging markets in massive amounts for basically 2 reasons. First, and the most obvious, is concerns over Fed, what the terminal rate will be in this cycle, and how that rate rise will affect the US economy and the global economy in terms of a soft landing or a hard landing. And the second reason was basically tensions between US and China and its implications for China's medium-term growth, its implications for global trade volumes and the global economy going forward. And also recently, China's economic recovery is somewhat disappointed versus expectations coming out of this second wave of COVID and lockdowns that they had. I think the issue is we still think that emerging market fundamentals are very strong, and on these 2 issues, I think we are seeing progress. As far as the Fed is concerned, I think we are seeing the light at the end of the tunnel. U.S. inflation is coming down, and U.S. growth is surpassing expectations. So we think that the probability of a soft landing in the U.S. economy has increased over the past 3-4 months. In terms of U.S.-China relations, we don't think we will see further deterioration. We think that it's pretty positive that the 2 sides have re-engaged. Maybe we haven't seen a big breakthrough yet, but the possibility of increased dialogue going forward seems to have increased substantially. And on China's recovery, there's been a broader sort of confidence issue that was the underlying reason why monetary policy easing has not been working through the economy. But we think that with additional measures, targeted measures that they are introducing, we should see some pickup in credit, and we should see better economic activity numbers coming out of China, which will be very positive for emerging markets going forward.
That has certain implications as we think about higher, global growth, rates stabilizing. Obviously, commodities come into play, commodity regions come into play, Latin America, Middle East, Africa, even some of the ASEAN markets like Indonesia. Felipe, maybe you could talk to some of these markets in terms of policymakers. What's our outlook for overall growth, as rates stabilize and potentially come down?
Yes. In EM, we've seen a very positive development of the inflation. In particular, we have seen in EM countries that start hiking very early on the inflation cycle. Therefore, they paused already almost a year ago. For example, the Central Bank of Brazil started hiking aggressively in March 2021. Therefore, they are at the moment where the Selic is at 13.75%, which is well above the natural rate, and their inflation is already progressing in a very positive manner. So, for example, year-on-year inflation is already within the target band. In addition, I would say that everywhere in LATAM, they follow the Brazilian Central Bank. They were aggressive. Inflation is progressing in the right direction, but not only in LATAM, but also in Asia and in Eastern Europe, where the inflation problem, for example, in Eastern Europe is more severe. The inflation is progressing in a very positive way. And in Asia, for example, they don't have the problem of inflation that we have in the US or, for example, Europe. Therefore, they are at the moment where we will start seeing inflation moderating and central banks cutting rates. So we expect an imminent normalization of rates in Latin America. As I mentioned, these were the first to hike. Therefore, they will provide stimulus to their economy and provide an impulse to the equity market through cutting rates. We'll start to see in the next quarters, 2 or 3 quarters, private consumption and the economy reaccelerating again. We have seen, due to the right policies, positive macroeconomic normalization in terms of activity. Those economies that were overheated, for example, that did a lot of fiscal stimulus, monetary stimulus, they removed the stimulus early on. Therefore, we're seeing now a very positive correction in activity, but also in the external accounts. For example, countries that last year had a very large current account deficit, we're seeing those deficits correcting in the right way. And that at the same time with a flexible exchange rate, and that helped a lot the economy to absorb the external shocks. And we're seeing now a very, very good improvement in this external account without the need to devaluate significantly the currency. So we're seeing a positive scenario on the macro front, given to the right policy and in the point where they are right now, but also the external scenario is helping emerging market, given the high probability of soft landing in the US, reacceleration of China, and all of this is positive for equity market and for the economy in general.
Yeah, our view really is constructive on global growth. There are 2 main drivers for that, really around the CapEx cycle picking up. When we look at global CapEx, it has turned. There are 3 drivers for global CapEx today. One is energy transition, which we all know about, moving toward renewable energy sources. The second one would be defense spending, something that didn't exist 18 months ago with the war in Russia-Ukraine. And then the third one is basically reshoring, friendly shoring, or de-globalization, which is basically causing a tremendous amount of CapEx in areas that we wouldn't have seen, a few years ago. The other driver, as we know, is the new tech cycle. And when we look at what's happening in terms of artificial intelligence, automation, we think that will be a driver for tech enablers when we look out over the next 5 to 10 years. And so those companies that benefit are semiconductors, are DRAM, companies like TSMC, Samsung, Hynix, Korean and Taiwanese companies. So we see basically a barbell of growth kind of across emerging markets, commodities doing well as industrials spending picks up, but then also commodity spending pick up. China also is really just coming out of the COVID recovery. We're in the early stage of that. The US actually is still seeing signs of a COVID recovery, which is pretty remarkable. So it's hard to believe that the COVID recovery is over in China. If you look at the portfolio today, it trades at about 12 times earnings, very, very reasonable valuation with 20%, 25% long-term earnings growth of those companies. Upside of the portfolio is about 40, 45%. So we still believe the risk reward for our strategy is highly favorable. thank you very much for your continued support, and we wish you all a great second half of the 2023.